Good afternoon. I've never done a live presentation like this before, but I will get started now and we will give it our best shot. I'm going to have you go at this very point since we sort of are going to go out of line a little or out of sequence a little bit. And if you would have the handout, which I don't believe you have at this point, the last page of the handout goes to the IRS new procedures. And the new procedures essentially are the ability to get transcripts and other e-services that the IRS now provides. Most of you that have practiced in front of the IRS in the past have had to get a power of attorney, which is a form 2848 when you want to represent a client. And the power of attorney form, you had to get the client to sign. And in some instances, like I have right now, I have a client that owns a business that was an 1120 and for a while, which is a corporation. And then they changed to an 1120S. And they also have payroll tax returns and individual tax returns. And it's kind of a complicated, very complicated situation. So you'd have to get a power of attorney and I identify each area that you are seeking information from the Internal Revenue Service. When we used to get powers of attorney, we used to have to fill out the form, go to the fax machine and fax it into the IRS, and then they would process it. And in about a week or so, you would be listed and you could converse with the IRS on the IRS hotline or through other means, so to speak. You might be able to talk to collection agents or otherwise. But when you did that, it was a little bit more complicated process. Now, hold on one second. You can take your coat off, relax, and our other instructor just came in. Now what you do is you can fill out the same power of attorney just the way that you always did, but you are allowed to apply online. And right now, since I already have some transcripts up here, you can apply online with your tax identification number, that with your CAF number, which is your number given to you by the IRS if you are an authorized representative. And then you can go into the IRS e-services and get your client's transcript. So what I've done here, which is on screen right now, assuming I can work this screen again, which I'm having some trouble. At any event, I have a client that I have reached out for their tax return transcripts. And I'm asking for this taxpayer number and the tax period ending 2017. And you can see here, I can't get their tax return transcript because it was for year 2017. I'm going to go back over here and I'm going to get the tax return transcript for tax year 2019, and you can see that I have access to all of the information filed on the return and the tax return transcript for this individual. This is very valuable if in fact you're going to be speaking with the IRS and you be able to determine what information they have already filed. In one of my last clients, they indicated that a substituted return was prepared by the Internal Revenue Service for tax year 2010. And I wouldn't have been able to get their tax return because the tax return transcript only goes to the tax returns. But there's another product, and I'm going to try to get back to that if I can, without getting to my client's name here. Okay. Well, I'm not going to put my client's name in again, but the products that I could get here, the product type I can get the wage and income transcript. So the wage and income transcripts go back several years. It's not just cut off by the local year, I mean, a 3-year limitation for the tax returns. But if in fact I had to do tax returns for somebody that from 2010 to 2022, which sometimes you get non-filers, sometimes I will be involved with people that are in immigration, have immigration issues. I had a client once that they immigrated. I think they came in on a visa. When their visa expired, they never left the United States. They ended up working in Pennsylvania. They ended up meeting a Pennsylvania young lady and getting married. I think they had maybe one child out of wedlock and one child in after they were married. But to get married and stay here in a legitimate relationship, which it was, they had an immigration attorney. When they went to the immigration judge, the judge required them to pay their tax returns for the past 10 years. And so by me using the wage and income transcript, which I could get for whatever year, here I would be getting what different forms. I get the W-2s, 1099s, other information, and I was able to complete their tax return. Another part here is the account transcript, and the account transcript provides an awful lot of information. And if in fact, like some of the clients that I have owe significant amount of back taxes, and then they'll ask me, well, I had a refund coming from year 2019, but it was applied to a prior year. Well, you can go back on the account transcripts and it marks down every time a payment was made and whether there was money. Let's assume that money was transferred from the 2019 refund back to the 2012 amount owed. And let's assume they got a refund for $2,000. There was only $450 owed in 2012. You could see where it would apply that $450 to 2012, and then it might transfer it ahead to 2015, where there was another amount owed, but it gives you complete explanations as to what happened and why. And it also gives you the information about what penalties were charged, not charged, et cetera. And so you get a lot of information from the tax account transcript. And let's go back to why I am telling you this. Everyone that I know that deals with the IRS, and a lot of people, I'm not sure if my two associates have used the e-services of the IRS. You have to use them for a little bit, but they've expanded it greatly, and they've expanded it through COVID. And they've expanded it to the point that's oftentimes anybody that's in my profession dealing a lot with the Internal Revenue Service, you can get really frustrated with dealing with the Internal Revenue Service. You can get really frustrated. And one of the ways I used to be able to provide more services than other people, because I used to make a lot of use with the IRS hotline. And with the hotline, I was able to get have a conversation with a relatively sophisticated person, because sometimes revenue agents just hired don't know some of the niceties about what's going on with tax. But when I was able to talk with a hotline, I was able to talk with somebody that could directly answer whether I had a pension plan issue, a pension plan termination. They could direct me with the right person and get me in phone contact with them, because sometimes you call the IRS and you're on the phone listening to music for 5 or 6 hours. When I used to call the hotline, it was about 10 minutes. With the IRS having reduced their staff through COVID, the hotline has eventually gone away. It's hard to use, but what's replaced it is the e-services. And I'm going to go back. Hopefully you can see this online. And what I'm doing I'm going to try to put into what you have to do to get to your e-services. Hopefully I'll be able to get there. And with the presentation today, I'm going to log out and log back in. I really didn't want to do that. Okay, I'm logged out. And I'll go all the way out so you can see where I'm coming from, if I can get there. Okay, well, I wasn't planning on doing things exactly this way today. Okay, here we go. I'm back to essentially the screen with the IRS, and this is the IRS sort of information, help, news, so on and so forth. That's something for charities and nonprofits, tax pros. And if I click on tax pros, that's gonna be another thing, but in fact, I'll click there for a tax pro. And I think I might be in that. And to the extent that I'm here, you see that I'm going to be able to look and find information. People that do tax returns may have to get into, get a P10 for electronic filing and other items. But one of the things that I'm going to go to today, in fact, you can see whether you're an enrolled agent, you can be an enrolled retirement plan agent, actuaries. One of the people on our staff today is Brad Barlow. He's an actuary that does retirement plans. But anyhow, getting to your Access e-services, and they have all sorts of explanations as to what you would be doing with your e-services. And what I utilize most is e-services, where I'm going for the transcript delivery system. And when I go through there's more explanations about it, but I'm going to access the transcript delivery system, and I'm going to sign in with my username, hopefully. And I'll put that in here. I put my username in there. It's already there. We'll see if my password's been already set. No, it hasn't. And hope I spelled it right. And then it sends a code to my phone, which I have my phone in my hand, which you can't see at this moment. Now, I'm just going to stop here for 1 second and state that in the past, I tried to become involved with the IRS electronic e-services system. The way you used to have to get into the system was you had to apply, you had to go through all the information, including, I think, what your mother ate on the day that you were born, on the way to the hospital, to get all information to them. Then they said, we will send you a letter to your home address, which would be in about a week or so. And I would either get the letter or not get the letter, but I was never able to finally register with the IRS system, to the point that I threw my hands up and said, I'm never going to use this. Now that I've finally have gotten into it, and it's easier now, and I think there's people inside the IRS that can give you some help when you are finally getting into it. But
they require fingerprints.
No, not yet. And one of the things that's going to come up is the real ID. And I'm going to bring up another thing. And Jeff Maislick's here. Jeff and I were this past tax season. I had a client that I think it was about the 13th of October. The 15th was the final tax day for the extension. And I went to file his return. When I went to file his return, it was rejected because he did not have a personal identification. So what I had to do was this 35-page tax return. I had to then stop what I was doing, make a couple copies of it, attach the W-2s and the other information I needed to, run it down to post office and send it in. And which is with the staff limitations that have been the IRS has experienced over the past few years, it seems like getting an amended tax return processed or any return process that's sent in manually is extremely difficult. I then get 150 calls a day about finding out where the refunds are of these paper returns that I don't even know if they were delivered, which is another issue. And everybody,
We're sitting on a table somewhere for 2 years.
see, my other advisors here are supporting me by saying that they're not sure where the returns get. But in any, obviously, it's no fun not being able to electronically file or return, whether or not there's more scrutiny on them. It's just delay, and whether the information's lost. The nice thing about the e-file returns, when you get them, you pretty much know exactly what you've sent in, and when they're paper returns, whether you made all the copies and so on and so forth. So there's a bunch of things that you can deal with that. Anyhow, I'm going to get down here, select your organization. I select the organization I have, and then I would go up to online transcript request, and the secure mailbox individual, so on and so forth, my name. I'm going to put my CAF number in here so you see what I have to do with the putting the CAF number in. And my CAF number is 2605-29139R, but you don't need to put the R on there, and you don't have the space, which the first time you do this, you'll probably make that mistake anyhow, or try to. And then I then have, and if I were able to not display the taxpayer's ID number, I could get the information, which is what I did before you were on. But if I wanted to have this person, because I had somebody that I had to go back to 2005 to 2021, and I got all of their account transcripts, and you can see where I put it in. I don't know why they have the 1040A, 1040EZ, 1040 non-resident. And then there's other ones down here, which depending on if you have you're looking for an S corporation or other items, which is what I had to do with the other client that I was discussing before. But when you do this, you make your request, you have to hit this button, add request, and then obviously it's telling me everything I've done wrong there. But then once you add the request, you hit the continue, and then it will bring up down below here all of the documents. It might be 10 documents that I would have down here. Then you click on each one, and then you're able to get the document, and you can print it out right in your office. If I would put the names and identification numbers of the client, or if it would be a corporation, I would be able to have all that information, where before I'd have to send in the 2848, wait a couple weeks till it was processed, then call the hotline, then try to get the transcripts, then get the transcripts delivered. And they say, we'll try to fax them. And if we can't fax them, we will send them by hand. So you would be a month, 2 months down the road before you could have a conversation about what's going on with your client. And then your client asks you, do I have to pay interest and penalty on the 2 months you had to wait? So it's that sort of thing sometimes, and everybody knows I'm up here dealing with this. But the point I'm trying to make to you, everyone here today, is I've started at the end of my presentation because I wanted to inform you about what is going on with the Internal Revenue Service with e-services and e-filing. And anybody that is working with this, I would tell you that you must do this because you're going to be left behind. And then when you go and try to, sometimes I do offers and compromises. After a client watches late night television and they see somebody on there that talks about the new way that the IRS is going to give you a fresh start and everything else, and you never see a true lawyer in that. You see somebody that looks like somebody that used to be on Knots Landing or Dallas. I'm showing my age here, but there was an educated looking sophisticated person. They say, well, here's what we can do and we will be able to save you all this money. Well, there is no real negotiation with the IRS. There's a certain set of things that you can do with them, but if in fact you don't have all of the information, because when you file an offer in compromise, you have to have every tax that they owe. If it's 1040 tax, you have to have all the taxes. If it's a corporate tax, you have to go all the way back and find out their complete account balances. So if you don't put all the taxes down and you get a release, and if you forgot the 2005 1120, which is corporate tax that wasn't paid, and if you only went back to 2007 and didn't include the others, you won't get a release from a complete release from an offer. And if you put that in, you perhaps would. But in any event, I'm going to leave the e-services now, and I'm going to go back to the sort of the first page of my outline, where I'm going to talk about, and since my delivery here is a little different, excuse me, I'm going to try to back here on here. I'll just go back to this tax return transcript just to show you that again. Okay, and I'm going to try to go back and on this screen, if I can get out of this part of the IRS, I can go clear back to it. Okay, here we go. I'm back a little bit further. Okay. I'm going to go to let's see here. I'm going to try to go to collection and enforcement. And see if I can get the IRS information from that. Okay. Here you have the IRS collection process. And one of the things that's happening is that the IRS is increasing their collection activities. They used to refer to it as a tax gap, where the IRS believes that there's a lot of people that are underreporting, underpaying, and there's a massive gap in what the IRS thinks it's owed and what the taxpayers thinks they should pay, which has always sort of been the case. But since the IRS has lost some of their staff and they haven't necessarily replaced them, They have put a lot more energy into cleaning up and addressing the collection process. And they've set up a file, and I'm going to see if I can find it here, but just to give you, hopefully there's a collection process. I'm going to, I guess this is the line we're on. And what I want to do is go to the Office of Fraud Enforcement. And see if this comes up. And of course it didn't. Okay, I'm going to go back. What the IRS has done is they've set up something they're referring to as the Office of the Fraud Enforcement. They have an acronym for it, which is OFE, and their main goal, there was a IRS memorandum 25.16. It was June 10th, 2021, where they're talking about improving fraud detection and trying to deal with fraud that is inside of partnerships and where people are promoting and or otherwise advocating, selling allegedly tax favored opportunities when in fact the IRS is looking at them as being fraudulent. But what the Office of Fraud Enforcement is doing, they are selecting and scheduling revenue officers and revenue agents to really look for fraud, look for what are known as the badges of fraud. They talk about hiring local fraud experts, which would be, I'm assuming, are forensic accountants that will try to trace down where people are sending and placing money, whether it be overseas partnerships, offshore accounts, etc. They're trying to use artificial intelligence and a lot more digital access to funds and bank accounts. And I'll go back to when 9/11 happened. When 9/11 happened, our banking system changed, and it changed because before 9/11, you used to maybe get a check from somebody in San Francisco. You take it to your local Pittsburgh bank. You present it to the bank. The bank then would take that check. They put it in a satchel. They put it on an airplane front and fly it to San Francisco. And that check would be presented physically, more or less, to the San Francisco bank to see whether it was paid. And then the check would clear. It took a longer time to clear. Because with 9/11, and let's go back one step, Congress already had this system prepared to go into place, but nobody wanted to do it. It wasn't urgent enough, and Congress sometimes goes at their own speed, if not always. But when they did that, there were 100 bags of checks on the tarmac at the Dallas airport, and the banking system kind of stopped because of 9/11, which was, a natural thing because everybody was sort of reforming and our whole airline system changed. But what also happened was that they put into being what is known as a substitute check. In other words, after they talked about the substitute check, I would go to Pittsburgh Bank, put the check I got from San Francisco, I would give it to them. They would then take it, copy it digitally with a microline, send that electronic new substitute check to the bank in San Francisco, and the bank in San Francisco wouldn't immediately cash it. They still had a leeway. In other words, if you wrote a check and it was bad the first day, you would get penalized, but the bank had an extra 3 or 4 days to clear it. But anyhow, it was much faster. But what that ultimately led to was the availability of the banks having all digital checks, digital assets. The bank kind of had that to a degree before that. But what it truly led to was QuickBooks Online, because QuickBooks Online, you can see all the checks, have it, everything. And QuickBooks Online almost does all your accounting for you once you get in, look at the check, find out where it should be allocated to. And what that does is gives not only the clients the ability to really identify what's going on with the checks, but the Internal Revenue Service has that same availability. And if you are sending money overseas or some other place that, I mean, there's a zillion wire check transfers that happen a day, so it's not necessarily nobody can monitor all of them, but if you're selected to be monitored, and as we're seeing with people that are trying to track down some of our politicians that allegedly have committed fraud or otherwise, but it's hard for the federal government or the FBI or anybody else to have the authority to track them down. But in any sense, if in fact they get the authority, like when the IRS selects you for an audit and they want to subpoena your records, they have an awful lot of information right in front of them, that's really changed there. So, but in any event, with the new emphasis placed on fraud detection with the IRS, that is something that's clearly going to happen. When I discuss fraud with somebody, people will ask me there's something called civil fraud and something called criminal fraud, or civil tax fraud and criminal tax fraud. And if you've ever been audited and you haven't identified or put in all of your receipts, is that fraud? Is that civil fraud? Is it criminal fraud? And it kind of goes to the magnitude of the amount. And when I've defended people that have been accused of criminal tax fraud, my main goal is to make it civil tax fraud, because obviously there's criminal penalties there. And that puts you in a difficult position because you're negotiating away the criminal and the IRS is there. Well, if it's not criminal, I'm sure you won't mind that it's civil. And with the civil tax fraud, there's civil tax fraud penalties which are pretty significant. And speaking of the IRS collection and ability to collect and fraud items, people that are involved with criminal enterprises of some sort, that they get criminally charged with bank fraud or wire fraud. There was a case here in Pittsburgh where there's a contractor that was overstating his bids, and it was for a big entity. I won't say what the entity is, but it ended up being like a $6 million case that they said that he, essentially stole money because his contracts were overstated, and he was charging for items when he was working on the Fort Pitt Bridge instead of the big facility. And so that difference, that $6 million, was not only a wire fraud that had to be paid back to the federal government with restitution, but also it was unreported money. So not only did you have a bill for the restitution for the the theft of the money from the contract process, but you also owed tax on $6 million. Now, my client was a manager, and they accused him of a couple things, but one was his van was paid for something which he was using it personally. I mean, it was stuff that was minor and wasn't even necessarily justified. But one thing that happened was there was one day it was raining and the people that were working, he says, well, I have some stuff, and he took the workers and they just worked on his house and maybe did some work on it, repaired his roof. And the value of that might have been, let's say $5,000, some number. And the total service that he essentially got was about $30,000. But he pled, in a plea bargain, he pled guilty to the conspiracy of being involved with this. And the amount of money he owed was the same $6 million because it was joint and several liability. And so his life has been essentially ruined financially. He came to me and I was able to get it sorted out and get in a lifetime payment agreement with him. But he is relegated to a $15 an hour job, so to speak. And somebody else in his family runs his company and that sort of thing. And it's always disclosed to the IRS to kind of identify where he was, because you can't make a false statement to them or anybody else. But it just emphasized the magnitude of the problem. And it was trying to go back, because he actually spent some time in jail. So it's 2 or 3 years past, and trying to go back and relitigate what the tax was just wasn't cost effective. And especially he wasn't had no ability to defend that. So in any event, some of the things that the IRS is looking for, they are looking for whether or not a foreign tax credit is proper. And a foreign tax credit is if you earn, and I'm giving you some odd things here, whether the foreign tax credit is appropriate because you earn money in Morocco or someplace like that. And what people will do, well, they'll pay real estate taxes and other taxes that are not really income tax, and they'll kind of declare them as taxes because it's not categorized. And then they'll try to get the full credit for maybe 50% of their income. And in the United States, it might be 20, their tax rate might be 20% or 40, whatever their tax rate would be. And they'll try to get a credit and get an overstated credit. So the IRS that's one area they're looking for. Another area is when your clients have business in foreign countries, there's something called FATCA, which is the Foreign Account Tax Compliance Act, where you have to identify all your various financial accounts. If you invest in partnerships in France and you're a partner with somebody that's doing some work in France that has a German partner or some other transactional partnership, all that information has to be presented. And if you are, let's say you're in 7-tiered partnerships in a foreign country, they're trying to look and see whether or not the depreciation is on the right form and so on and so forth. So obviously it gets very complicated, but this is another area where they are looking at. Another thing that happens is sometimes foreigners will own real estate in the United States. And I think Jeff and I had a case like this where they sold and transferred the property. And when you sell or transfer it, and I even think with a partnership, when they have yearly distributions, you have to withhold on the distribution. So there's withholding tax what foreigners have to pay. So that is another area that they're taking a closer look at. Another area is trying to identify non-filers, and particularly high-income non-filers. And this is a recipe for criminal and civil tax fraud if somebody is in those areas. And this is the purpose of this course today is kind of give you an update on what's happening. And so some of the things that are happening that the IRS is trying to do, they're looking for that. They're also looking for related party transactions where somebody owns a corporation and he transfers funds to his son, daughter, somebody else, or gives them a contract where they are paying taxes at a lower rate, kind of a thing. So that could happen. Something that happened last year for anybody that's filing tax returns, for anybody that is an S corporation shareholder, they had to, because people that are in S corporations, the basis calculation there is very significant, because if you have a loss in an S corporation and that loss is supposed to flow through to you, and let's say you have a W-2 from another company of $120,000 or $150,000, and you have a $70,000 loss in your S corporation that you're a shareholder. If you don't have adequate basis, you are not allowed to take that loss. And so the IRS has not had a good, accurate ability to crack down on people that are taking losses in excess of basis, because it just was too complicated and difficult. And what the IRS has started doing back in 1986, when they changed the Tax Act, they're trying to make everything as digitally and computerized, readable. In other words, they're trying to just look at whatever is there numbers wise and then do their auditing based on in-house digitally transferred data auditing. So since they didn't have a database of shareholders of S corporation basis, they have forced everybody to file, I think it's the 1720, is that the right form? 7203, the basis thing, and that you have to submit that as a PDF when you file electronically. You have to calculate the basis of a shareholder and then submit it. The good thing, I guess, is that since there wasn't basis calculated before, you had to go back and try to calculate it and set it forth. I don't know, everybody's with their pencils sharpened right now on figuring out what the basis for all the shareholders was. And it's an enormous burden on an accountant, because you just can't have a conversation generally with a shareholder about his basis, because they'll tell you, I gave you all that stuff last year, tell me what my basis is. And it would go back several years, and you'll have, it's something that's been difficult to do, and we've had to reconstruct. And the IRS sort of recognized that, at least so far. There hasn't been a run on audits of it, but they clearly will be coming if you don't have the proper basis. Another area where they're looking at is when somebody sells a partnership interest, because in partnerships, often what will happen is, and this is the reason why people with real estate put the real estate in a partnership and put the operating businesses in an S corporation, because in a real estate partnership, you can borrow money from a bank, and let's say you buy a house or a commercial building for $200,000, and you borrow $100,000 against it, or even borrow $200,000. I'm get 200. So you borrow for the whole thing, and there's two partners, and if they have losses each and every year, they can deduct those losses because their basis is increased by the amount that's borrowed there. The problem is, when the property is sold and the basis of the partnership property might be $50,000, and they still owe $150,000 to that partner on the loan, they have to pick up the difference between the basis and the amount of loan existing. And oftentimes that gets muddy when it gets presented to the IRS. And the other thing that happens is, they can have what is known as a negative capital account because they've taken more losses. I mean, they can have a negative basis. So they have to clean up the negative basis when they transfer it, as well as the difference between what the basis is and what the loan value is. And if they get cash for it, it even makes it worse. So I'm trying to address some of the other things that's happening. Another area that's happening is the virtual currency. On the front page of the tax return last year, every accountant had to answer the question whether or not the person was involved and invested in any cryptocurrency, because there's no real adequate records for that, like there is stocks and bonds. And some of the people that were dealing with cryptocurrency, I don't know if you guys had any of that problem. Yeah, I had a couple, and
Nobody admitted it.
well, one of the co-hosts here indicated that nobody admitted what they did with the crypto, but if that box is checked that they didn't do it, that's a false statement. And a false statement, with the way the news is being broadcast today, where they have facts and alternate facts, it's hard to demonstrate what is a false statement. But the reality of it is, a false statement is a felony, and it's a serious felony. And people that sign the tax returns and they don't check the cryptocurrency transaction, that's essentially a felony. It's a false statement. And whether or not the IRS, if you're defending somebody like that, your defense is, well, my client really didn't see the box, he didn't know what it was, and wasn't sure. There's 1,000 defenses, so to speak, that they didn't know what they were doing. If I had a client that started investing in cryptocurrency, and he and his spouse probably hadn't earned much money for the last several years, and all of a sudden they had like $250,000 worth of revenue because they taxed all the various transactions. It was pretty significant. So, and of course now this year, I guess they balanced that because they've lost it. I don't want to laugh, but it's unfortunate fact here. So another area that is under scrutiny is the micro captive area. And normally most of the time I speak with live audience, and I would ask them, do you know what a captive is? Do you know what a micro captive is? And the responses I get, I'll say, well, I think that's insurance, so on and so forth. Well, a lot of companies have captive insurance companies because they define an insurable risk, and they put together a reserve, and it's more like if they would be paying State Farm insurance than at one company's name. If there's a risk you're trying to cover, and you pay $100,000 for insurance for that risk, blast furnace insurance, for example, something really bizarre, that it's something that if there's no loss, the insurance company makes a profit on your insurance premium. So if you set up your own insurance company and have enough wherewithal to back it, you can set up your own insurance company, make money, and take a deduction for the liability insurance payments you're making. So what happened then would be somebody would get in touch with a doctor or a professional. I'll use a doctor, not that I'm not trying to pick on them, but a doctor has malpractice insurance, and they'll have malpractice insurance, but they'll have for risk of running that type of a program, or risk of not being able to have anesthesiologist at the item. So there's a lot of risk out there that can be categorized as an insurable risk. And then naturally what people do with that is sometimes they overstate what the risks are. Now they have to have somebody, an insurance risk advisor, run an opinion that it is a risk. but it's, those people are being paid to evaluate a risk and they find risk. And oftentimes the insurance companies would be a captive insurance company somewhere down in the Bahamas. So you'd have your insurance advisor down there and the money would be out of the country. And one of the reasons people would put the money there would be there's no income tax on it. So it was an advantageous thing. Well, people got carried away with that and with these captive arrangements, because it's kind of like U.S. company pays into the captive insurance company. And then at the end of the day, when the captive insurance company is there, all of a sudden they make a distribution back to the main company or the shareholders, or they put $500,000 down there that they take an expense for as an insurance payment, and then they borrow money back from it from themselves. So it's, for lack of a better term, it could be considered self-dealing. So whether or not it's a bona fide insurance company or not is one of the areas that the IRS is going after. I could try to get into what the bright line tests are, whatever they are, but if you're involved with a captive situation, you would know that. And on the other hand, if you are trying to find deductions for somebody near the end of the year, you might want to suggest a captive if in fact you can set up a bona fide captive, which there's people that do that, and I've worked with some people that have done that. There are the IRS is also trying to focus on anybody that's promoting or a material advisor in promoting tax shelters. And they actually have now what is called the Office of Promoter Investigations. So if you're going to be anybody that's doing any of these kind of things, they've established a category. Whether or not they can staff it is another issue, which we're all dealing with the staffing issues. Obviously, the IRS is no different than anybody else. But if you are selected, anybody that's hearing this presentation today, you become an investigator in the Office of Promoter Investigations, and you're going to track down somebody. I wouldn't want to be the person you're tracking down, because it's a serious problem. And anybody that promotes anything, it's you're promoting a captive. Well, how do you know the captive is appropriate, and so on and so forth? I don't want to get too far down that road, but in any event, though, that's one thing that's new. Another thing I want to point out is in 2015, they started changing the way the partnerships are audited. And when they do that, they are really aiming at the tax matters partner. And if you have a partnership with 100 partners, you invest your money in there, and you are going to be subject to the same penalties because you're an equal partner, and you can share with all the penalties and losses. And if you get the partnership K1 that you rely on and utilize for losses or not filing income, or the partnership didn't report all its income, or improperly on the 17 tiered partnerships from France, they're trying to address those, and that's a massive problem. But that's one of the things that is being undertaken, or tried to be undertaken. One other issue, and I'm going to be meeting with a foreign family later this week, which is tomorrow actually. And one of the things I'm going to have to discuss with them is, do they have assets in another country? And do they have bank accounts in another country? And the rule for a bank account is the FBAR, which means that you report a financial bank and a financial account that you have to do. And whether or not you are filing those, I usually go into a couple things. There used to be secret Swiss bank accounts that you had a number, but they didn't, identify you as an individual holding it. And the IRS wanted to understand where anybody had assets, millions of dollars. Say if you had a $10 million in a Swiss bank account that's in your name, and it was okay, and there would be promoters or material advisors that would tell you to invest in these secret bank accounts. And I'll go back to what I'll call is the Panama Papers, because the Panama Papers was a time where many of the people that had money in Panama banks, Putin, for example, the heads of state, oligarchs, would have a lot of money undisclosed is in Panama banks, and they thought they were completely safe. But what happened was somebody hacked into them and identified all these funds that were in there. And I'm not sure what exactly happened to any of those people from the Panama papers, so to speak, where that was disclosed. But what happened to the Swiss bankers was this. They realized that anybody in the world, the most sophisticated people in the world, could be hacked and found out. And if the IRS is after you, president of Credit Suisse, and saying that we want to know whether or not you, president of the bank, are helping somebody hide the fact that they haven't declared and paid tax on money, we want the information. So the IRS was able to get the information from the Swiss banks, because you can't, the Swiss banks now have to disclose, just like every other bank, interest, dividends, et cetera. So that is something that you have to watch for. And if you have a client that has money in a foreign bank, say you have somebody that's 10 million in a foreign bank, and if they find out, the IRS finds out that you have money in there, the penalty on that is like 50% of the bank account. And then you still have to file and or explain whether you got gift income for it. I'm not gift, I mean gifts for that, which might be subject to federal, state, or federal gifts tax. And then you have to include, if you have, even if you, the penalty is 5 million, but you still have to determine if you earned income, and that income from your US business or whatever business around the world was placed into this bank account that wasn't reported on a US tax return. So not only the original penalty, but you may have interest and penalty that could go back several years to determine whether or not there was issues. So when I talk to my clients tomorrow, I have to make sure that I inform them of that, and to the point that I have to ensure that I've asked them it and they've told me either yes or no. And if it's no, and then if they end up with it, because more often than not, their defense is going to be, my accountant didn't tell me I had to report it, or some such thing. So it's not necessarily a fun area. Okay, if you had the outline on page 6, the procedures, collection procedures, and how to resolve the procedures are there. And this is if in fact you're going to be watching TV tonight and the guy's going to come on and tell you how there's a fresh start in the IRS, I don't see any fresh start here in the collection procedures and resolutions that I've gotten from the Internal Revenue Service. And I'm gonna, if you had the outline, the first one's offering compromise, the next one's installment payment agreement, partial installment payment agreement, currently not collectible, and essentially those are the main 4 things that you can do. Getting in its, and I'm going to start with the payment agreements. What'll happen if you owe money and you can't pay for it all at once? And right here, what you'll have to do, and I'm clicked on form 433A, where you have to provide information. If you were self-employed or a wage earner, I'm just going to use this because it's kind of the same for anybody that's in corporate tax or anything else. But you have to list all of your assets, all of your financial information, your personal bank accounts, your investments, if you have any digital assets, property, real estate, any other stocks, bonds, insurance policies. And essentially, it goes on that you have to identify and sign this under penalties of perjury, in essence, and you have to provide your monthly income and expenses. And what happens here is whatever your income is, whatever number you come across here, but when you put in your food, clothing, and miscellaneous, and let's assume that you live and go to, I don't know what the most famous restaurant is. I think the Chop House up in the North Hills is one of the, it's fantastic food. And I had one meal there. I think it cost me a month worth of food, but it's very expensive. So if you go there every day and you paid $1,000 a day for food there, you could put, oh, I have food and clothing of $30,000, $28,000 to $31,000 a month. And what the IRS does is they go back to the standard food, clothing, and housing allowance allowed for Allegheny County, Pennsylvania, which might be higher than, McDonald's food, maybe. But and if you have spent $1,000 at McDonald's, no, never mind. But in any event, what they do is they have the standards, and what happens here is they go down through all the standards of what it costs to earn on a car, what it costs to gasoline, whether you don't have a car, public transportation. It's all calculated here, and they I don't want to say are generous, but they're reasonable most of the time. If you can come up with reasonable expenses that are pretty close to what the standards are, you're going to get something there. But if you have gross income of 10,000, I'm pointing my finger there and I realize you can't see it here. If you have gross income of, $10,000 and your expenses here end up, because you have a family of 4, end up being $9,000, that means you have $1,000 worth of excess income. If you have a family of 2, that your expenses, you have 10,000 over here, and even though you put $9,000 worth of expenses, they will reduce it, and they only giving you allowance for maybe 6, and you'd have $4,000 worth of excess income. And the IRS wants your payment plan to be that excess income. And if you have a higher excess income, you would then try to indicate, well, this is just for monthly, but every year my client has to buy a new truck or some other item. So you try to renegotiate and come up with a number with the payment plan with an IRS agent, which is something that you can do. And I'm going to go back. Hopefully I'll be able to get back to, I lost my page here. If I find an offer and compromise here. It's
What options do I have?
okay, there it is, offering compromise. Okay. Now, the offer and compromise booklet here, and what essentially it is, it's this is the guideline, and this is a guideline I'm going to be trying to explain to my client this Friday, where I'm going to be talking to them. They are getting some money in, and they're going to say, well, Fred, why don't you take this $250,000 we got because of it's a long story how they got it, but essentially they were forced to sell a house in Florida, and they ended up with $250,000 because the price went up, and it was essentially foreclosed on, and they had, after all the bills were paid for the foreclosure and everything else, they ended up with $250,000. So when they say, well, we owe $2 million, why don't we offer the $250,000 to them? And they believe that it's just a pure negotiation, just like when you want to buy your neighbor's car that is a 1967 GTO, and he thinks it's worth 100,000. You want to give him $20,000 for, and sometimes there's a negotiated price between the two. The IRS does not work like that. What the IRS does is they require you, and I'm just going to put it in terms, and you can go through this booklet. And what happens here is you have to fill out the same 433A, but it's the offer in compromise amount. And you do the same thing. You add up all your assets, and then you go down here to try to find out again what your excess income is. And essentially what happens in an offer in compromise is you must determine the value of every single asset you have, and whatever that number is. Let's say my client has a house worth $500,000 and a mortgage on it of $2 million. So that means they have $300,000 worth of equity in the house. And I'm going to say they have a car that's fully paid. It's a 2017 Buick that's worth $20,000 fair market value. So that ends up that their total assets would be $320,000. And if they have excess income, which we talked about before, if they have that family of 8, their excess income might be $1,000. If they have a family of 3, their excess income might be $2,000 a month. What you have to do with your offer is make an offer of the total amount of the assets that you have, which in this case would be $320,000, plus 48 months of your excess income. And if it's, so it would be, in the first case, it would be $320,000 plus $48,000, or $96,000 if it's the second case. So you're looking at, a substantial number, $370,000 to, $430,000 that you have to make. That's your minimum offer, unless you can go back and revalue what the house is worth. And if if the plumbing blew up the day before you make the offer, you're the only guy that's excited about it, because it's going to lower the value of the house and lower the value of the offer you make on that day. Because that is, there's a lot that goes into this, but it's not, and you can see the amount of paperwork you have to do. To put together an offer is quite an expensive process. And what I've seen happen from, I shouldn't say seen, from all the stories I get, somebody, if you call that fellow at 2 o'clock in the morning that's on television, they'll say, well, here's what you need to give me. Give me all your information. I'll put an offer together. Then they'll submit the offer, and the offer will invariably be rejected because they didn't provide enough information, so on and so forth. You spend $5,000 or $10,000 or whatever the number that they want to, and it could be more, I've seen it more, where they gather all this information. They're actually doing a lot of work, but the work doesn't get any result. And they make money, and whether they actually put in good information or not to the IRS, the offers fail, or they're improperly done, or they give it to some, I'm not sure who all is doing it. Sometimes the accounting is done in foreign countries, whatever. And so they're paying somebody in Indonesia $200 to put your offer together. They're making $6,000 on it, and the offer is rejected. Because if in fact it doesn't pass the first time, they're generally not back in there interacting with the IRS trying to come up with answers for you. And that's something that happens. Okay. Another issue I'm going to bring up, it's on page 7 of my outline here. I don't know how much time I have left. I got some time left. Okay. One of the ways that the IRS is collecting or has proposed to collect is passport revocation. So let's assume that my foreign client now is a United States citizen and has a US passport. And if they don't have dual citizenships from somewhere else, and their main thought is, you know, my husband's older and I think I'm going to, you know, get divorced here pretty soon as the IRS levy hits. I'll get divorced, I'll get on a plane and I'll go somewhere else, back to my home country or some other country. And what's happening is IRS has put together a process, and actually it started in 2014, where they can revoke somebody's passport. This is powerful because there's a lot of people that, you know, Pennsylvania, people live in Pennsylvania and they're Steeler fans and they never get out of the tri-state area. In New York, they never go back to New York and they're flying all over Europe. And, you know, I'm just trying to make a point that there are a lot of people that rely on their passports and it's very important to them. And if somebody has committed tax fraud or something else, and that's another element there, but from the person that owes a lot of money and the IRS thinks that you have it and you're putting money in foreign accounts, they will not hesitate to come back and revoke your passport.
Against on that, I think, first of all, you mentioned fraud. I don't think that there's a requirement for fraud.
Yeah.
To revoke a passport. It's a $54,000 tax liability.
Yeah, I think you're exactly.
You know, which can sound like a lot of money to some people, but
It isn't.
That's really small. I mean,
yeah. What Russ Roll, one of the presenters here today, just pointed out is the threshold for whether they can revoke your passport is $54,000 in tax, and it's not very hard to, if in fact you've, you know, I think I mentioned about the immigrant that hasn't paid tax for 10 years. When I file his tax returns and if he owes $3,000 from 10 years ago, that's could be $7,000, $8,000, $10,000 with interest and penalty and failure to file and all the other things. So it's pretty easy to get a significant amount of taxes owed. Have you had anybody with passports revoked?
I've never seen it.
Yeah, I've come across it.
I'm sure we have ones that will.
Yeah, they're in that category. Let's say what we're sort of saying here, the three of us up here, we're saying that the IRS has been a little lax because they're understaffed, but they really have some power, particularly with this, where things that people were able to do. You know, my daughter's having a wedding in Italy coming up, and I want to make sure that I get to it. Revoke their passport. I mean, there's things that can and will happen. I'm going to go ahead a little bit more since I'm on a roll here. On page 8, and this is why I do not believe that there has been any laws passed in the Biden administration as it was, because they talked about changing some of the estate and tax laws. And with the administration coming forward, there's been a lot of energy. Why haven't they changed the tax? Why haven't they raised the corporate tax? Why haven't they changed the estate tax law? Well, one of the main reasons is we're in almost a 50-50 country. You looked at the election where in Georgia, the runoff election, and it was a quote unquote a sweeping win, and it was 50% to 49.9%. I mean, the races are so close that if you're going to be the one that's going to increase or change the taxes, that's something that you don't want to do, particularly because the tax law that went into effect starting 2017, ends at the beginning of 2026. Tax laws that aren't passed by a 60% majority in the Senate they have a sunset provision, it's called. They only have a 10-year lifespan. So what we have here is, and I'll use estate tax as a key. The estate tax credit shelter amount in 2015 was close to $5 million. Now, I calculated it here, I have the number here somewhere, but it's close to $12 million right now. And it was 3.5 million, went to 5 million, and there was some debate about that. Not really wanting to get into it, but obviously, from 2017 until 2026, was 10 million, subject to inflation, and right now it's 12 million. So you can transfer $12 million estate and gift tax free. And another thing that goes along with there, it's called portability. In the old days, you had to really maneuver to make sure that if your husband died first, that you had to structure your will in such a fashion that whatever he didn't use for his credit shelter amount went over to the wife's estate, or he used his credit so that whatever remaining the wife got. Now with portability, any amount of his credit shelter that he doesn't utilize can be transferred over to her. And they made that law permanent. It's on page 10. The portability provisions of the 2010 Act were made permanent in 2012. So the portability, and the portability actually happened before, when the tax rates were, I think, 3,500,000 back then. But the portability is something that's changed the way that all estate planners prepare wills now. They used to be the standard, I call it the AB will, where the amount went to the wife that was a deduction, and anything that wasn't a deduction fell into the credit shelter amount, so that the husband could use his full credit. So when the first to die, you didn't have to pay any federal estate tax, and you sort of pushed it over to the wife's situation. And if she lived, I mean, there's ways that you would try to minimize what she would have to pay. But that is something that happened. And what we also need to know, this is a federal estate tax, but all of the income tax changes, I have a list of them here. On page 12 of my outline, I talk about the federal income tax provisions, where they changed the maximum income rate, was reduced from 39.6% to 37%. The standard deduction was increased to 24,000, and then most of the itemized deductions that everybody was so excited about having, which is the mortgage interest, the state and local tax deduction, the unreimbursed employee business expenses, all those were radically changed by the Tax Act, and all of those are going to return in 2026 unless there is a new tax law change. And I anticipate that either the tax law is going to sunset, and then somebody's going to have to do something, because there'll be a ton of pressure on Congress to file a new tax law in 2026, or they'll file it in 2028, retroactive to 2026, which makes everybody crazy, and everybody that's smiling up here that's done this. So that is kind of where we are going with this. The one thing I'm going to focus you to page 14, which is tax year 2025. All the foregoing items that I have listed, and there's a whole list of them there, they will all not apply after 2025 unless you have further legislation. The anybody that does trust law, one of the things that used to have in estate and trust is when they had excess deductions in a trust, you were able to use them as itemized deductions, which that they were eliminated and changed, and that kind of changed the way anybody that does trust tax you need to address that. I'm not sure what anybody did about it, because if they had excess deductions, they just got lost instead of being able to be utilized. Okay. I'm going to turn over to income tax brackets and additional taxes. And I have Jeff Maislik here to talk about that if he's ready. And one of the things that we're talking about it is the end of the year tax planning. And Jeff's been an accountant for several years now. And, you know, I kind of asked him, what does he do with his tax clients at the end of the year? And that's kind of what he's going to talk about. I have in my outline here, it's too bad I don't have my outline on this page. I probably should have done that. I might try to do that. I'm not going to try to do that. Anyhow, I'm going to let Jeff come up and speak, and we'll talk about what he does for tax planning at the end of the year. And he's going to talk about what he does to address different brackets and trying to get away from the net investment income tax, capital gains, and that sort of thing. So, Jeff, good luck. And it's funny looking at yourself in the picture screen.
Yeah. So people always at the end of the year ask, well, what can I do about saving taxes and keeping out of the higher brackets? I get clients that ask, what bracket am I in? Or what percentage of income am I actually paying based on what their, what their adjusted gross income is or their taxable income. If you take the tax liability and divide it by the adjusted gross income or the taxable income, you get a different percentage than what bracket you're in, because the brackets go up initially from 10%, and they can work all the way up to 37%. And the key is to keep brackets out of those and keep income out of the step up from one bracket to another. You want to try to even it out from one year to the next. So we have to understand that there really isn't any good way to not pay tax on dollars. Even depreciation, for example, is just a deferral of income tax. So if you can take depreciation 1 year, at some point you're going to have to recapture it. So if you can even out the brackets from 1 year to the next and maybe divide up the depreciation, for example, over a longer period of time, it may even out your taxable income, as opposed to taking it all in 1 year. It's nice to be able to take a $60,000 deduction for a car that you may have bought, but it's going to come back to bite you down the road, because you're going to have to pay tax when you sell that vehicle at a profit. Because every time you take depreciation, it reduces your basis. So if you sell the car at $40,000, the depreciation that you've taken comes back and you have to be taxed on that. So what we try to do is try to take a ordinary income and move it to capital gains at the end of the year, which means short-term gains are taxed as ordinary income, but if you can take it over a year and timeline, you get a 15% bracket, and that's the only thing you're going to pay. So it's a matter of sometimes telling the client, hold on to the asset until next year, get a long-term capital gain on it at 15%, as opposed to paying short-term capital gains, which is at the ordinary income bracket, which can go up to 37%. That's one way to do it. The other thing is, for example, I have clients that will have large bond interests that they've accrued through the years. And we try to get them to, instead of taking all, if you have $100,000 of interest that you want to take, you need the cash. What you may want to do is divide it up over a 2-year period and cash in your bonds in December and pay tax on $50,000 and wait until January to do the rest and pay tax the next year on it, just keeping it into lower brackets. As the income goes up, obviously, so does the tax bracket. There's at this point the really, people want to put money into retirement plans, for example, and that's a nice thing to do to save current tax dollars. But at some point, when you take the money out of the retirement plan, you're going to pay tax, and it may be a higher bracket than what you're actually putting it in at this point. I actually told a client one year, he was in the 15% bracket. He wanted to put as much money as he could into an IRA. I told him that knowing his circumstances, he's going to be saving 15% on those dollars if he does it the current year. I knew his parents were wealthy, going to be giving him part of an inheritance down the road. And he was a professional. He was going to be earning more tax dollars. So he would be actually, as he gets older, paying tax at the 37% and saving the income tax at a 15% level today. I've told him, frankly, save your money, even though it's going to cost you more dollars today. It's actually going to be costing you more dollars down the road when you have to draw the money out of the IRA. He didn't like that. He wanted to save his dollars today. I said, it's up to you, but it's really one of those things that why pay more tax down the road than you have to if you just invest that at the time it was $2,000, put it into an account and let it grow. And you only have to pay tax on the increase at a 15% level, not the ordinary income tax level. Again, IRAs are taxed at ordinary income, and they could be taxed at the highest bracket.
Jeff, I have a question. Do you ever have any involvement with the net investment income tax? Do you ever suggest to people, because sometimes if you have a lot of capital gains, that can push you from the lower capital gain rate into the higher 20% rate. And then on top of that, if you have excess and have other earnings, that can get you into the 3.8 net investment income tax. Have you discussed that with your clients with capital gain?
Yeah, what Brett is talking about is once you earn a certain amount of income, any investment income, which is dividends, interest, capital gains, real estate, is taxed at the bracket plus another 3.8%. So that takes you into a higher bracket also. So if we can, as I said, when we talk about dividing up the interest from the sale of bonds into 2 different years, if you can stay below that threshold where you have to pay the 3.8%, it saves you that extra amount, and it evens things out between the 2 different years. The people don't realize about the 3.8%, and then when I send them the tax return, what's this extra dollars for? And it is that extra tax on the dividends, interest, and as I said, capital gains in real estate if you're investing in real estate. So that's one way of if you just by evening it out from one year to the next, don't take those extra dollars to put you into the higher brackets, because that 3.8% actually is a hidden tax that most people don't really think about.
One of the issues I came across was somebody at a corporation, and one of the things people have to get money out of a corporation is they'll rent property, and they do it for 2 reasons. One, they'll they'll hold assets in their own name or another LLC name, and then they'll rent off the corporation. So if the corporation goes bankrupt, then they still have the assets, and that's a pretty good strategy. And they pay rent to that. And that rent, if it's too high, you can get into the net investment income
That's right.
tax.
So the rent is also an investment income, so that it's taxed at that additional 3.8%.
Yeah.
The other thing we have to be careful of is that if you're it's referred to as a passive activity, and you may not be able to deduct a certain amount of passive activity losses for rental income if you're not actively involved in it and you have losses. So we try to work with the client to determine whether they are actively involved or not involved at all. If they have a manager, for example, that's managing the property, you're not actively involved, it becomes investment income. So as I said, that's one of the things. Excess depreciation won't necessarily help you on if you put a lot of money into that property, because you're limited to how much you can actually deduct. You can only deduct losses to the extent that it offsets investment in other investment income.
When you have passive activity, one of the things that I've tried to do, and I think we talked about this a while back, was when you have somebody that has a property or a business that terminates and you have the excess passive losses. That's one thing I'm actually confronted with this year, where massive investment ended up with a double loss, and for two members of the family were shareholders, and then the family had an interfamily loan, all of which ended up with substantial losses that they had these suspended losses. And have you ever addressed terminating business when you can take those suspended losses? Have you planned with those?
Well, as I said, you're limited to the amount of loss that you can take. So whatever is not taken gets put into a holding account and builds up through the years. And at some point, if you were to sell the property, those losses now can offset the gain that you might have on the sale of the property. For example, if you bought a piece of property for $65,000 and it's accumulated to over the years to a $400,000 value, when you sell that, you would have almost all gain on that, because your depreciation of the $65,000 takes it down to a very low basis. Whatever passive activity losses that you weren't able to take now gets to offset that $400,000 of sale for the property. So down the road, it helps, but in the current years, we have to be careful about whether or not you're going to go over the $25,000 passive activity loss limitations.
Have you ever planned to terminate, have somebody terminate their business before you're in, so they can take the accumulated passive losses there?
Well, I usually don't tell people to let the tax code wag the tail. Okay, somebody says to me, should I buy a new vehicle, a $60,000 vehicle, so that I can write it off this year? My answer usually is, don't do it unless you really need the car. You still have to put the cash out for it. And even though you're going to save taxes on it, at some point, as I said, depreciation will come back and have to be recaptured. So it's not really a good idea to do that. But if you need the car, buy the car. Sell the property if you need to sell the property. But
sometimes the sale is driven by the other game. Now,
Right.
You talk about that people that get into buying a $200,000 truck, and they get all that bonus depreciation.
Right.
Can you talk about bonus depreciation and explain why you don't use them? I think you kind of did all the time.
Yeah, I find that when you have a $200,000 truck that you buy and you get to depreciate, it's all wasted in that first year. You can only go so low in the tax that you're going to pay. So it may take you down to a 10% bracket by doing it, but that vehicle is not going to last forever. And when you sell it, now it's gonna have a value sorts. So, or if you trade it, trading doesn't do any good anymore because you have to treat the trade as a sale now. So if it's worth, if $100,000, you bought it for 200,000. Now that $200,000 that you've taken as depreciation, you have to recapture the $100,000 of it and pay tax at a higher rate on it. So it doesn't, it doesn't necessarily pay to take the $200,000 deduction for it. I usually spread it out over time so that if you sell it after 3 or 4 years, you don't get it hit as hard on the tax liability.
So as your
Some-
year-end planning would be that you would try to balance the whatever tax they're going to be paying over the time, and then not, one of your planning is not to take the bonus depreciating. Congress thinks it's a wonderful thing. We've given you all this bonus
right.
depreciation, and it's a benefit that you oftentimes don't want to take, and it's better off not utilized.
Because of the brackets, you don't want to be going up and down and higher bracket one year, lower bracket another year, middle bracket the next year. You want to try to even it out so that you're in the middle income tax brackets each year. I mean, it's nice to be able to be in the 10% bracket, but that means that you're not making very much money. So those people that have a tax problem are usually in the 22-24% brackets now. They want to start, they're talking about changing the brackets next year. They've been talking about it for a while to tax people who are earning more than $400,000. They talked about it, but they haven't done anything about it so far.
Yeah.
So.
Okay, so that's good. Let me jump up here for 1 second. It is a good time, but we have people on, I guess. Okay, well, it's time now for us to take a 10-minute water safety break from my swimming class from the YMCA when I was a kid. So that's what we always did. So anyhow, we're going to take a 10-minute water safety break. Thank you. We'll be right back.
Oh, yeah, definitely. I felt bad that when she said coffee, I felt bad I had to run to the men's room earlier. Because of the coffee.
Yeah. Oh, somebody, that would be our meeting. Okay. Yeah, what do you do? Okay.
do a lot of specification errors. That's concerns. I wouldn't mind going somewhat that, there's possibly going on with farms. And who are family farm business. We keep them at the same time. And, I don't know if someone is there. But, she had three children and, we'll, all three together. Daycare. And what happens is one day, and as they benefits the walking on those. And well, that's one. Coming to the bottom of the farm, and spending time on everything and real estate. Before that, I would say the property and all that. More than 1 year in the decade, and I'll see somebody else. Put it into a trust. But instead of a trust, that is, people not be able to keep it. What people want is better hospitals and a better product. I've never done it. Oh, this is the house. You were the same, about the same building. Right on the files. I can think of law. Next law. It's not me. what is the kind of one, yes. We have a transcript. You can come to the story. Here, Nancy doesn't know. That's the benefit. You don't, you didn't have that. Where I found hard to some of the other states are outstanding. But we need to have and the respondent I saw all the facts. I didn't sign it. Facts. First, and then that's why they are like and it's all ours. I'm sure you know. being paid. I don't use well, that's no, I don't want to be there. Yeah. Terrible. Terrible. Terrible, not they are. I was thinking both on the topic. Is what we now. Organization on these sides. Now, we have a facility for they were talking about how we prosecute the definition of the top and the all. You have a simple case. And then you have criminal. One of our motives is that we really need to question human evidence. He had a response about it. Issue of let's say attorney, you have been with you would think about criminal tax law. And this the line of what into so that come out problem. Based on, even though, see, and the big question is probably, and these prosecutors were, they were saying things about them when you report them. I don't know why they were doing that if they weren't going after them.
I don't. I think it's as Russ said, you have to be in the organization or not in the organization. Okay. We're back here and I'm going to have Russ Roll come up here in a second and talk about some ways to address when you have a very wealthy taxpayer that it has a fair amount of assets that has a charitable inclination, and there's ways to avoid some capital gains and some income taxes with that. So that's coming up. But right now, I just want to talk a little bit about the retirement plans. Jeff mentioned this when he was talking about year-end planning, and I often talk about it with the various retirement plans that you can get into. And one of the reasons why it's good for retirement is that, for example, in 2021, if you have $100,000 worth of income and you want to put some money in, you can reduce your taxes by putting money into a retirement plan. You do not have to make that contribution to the retirement plan until September 15th of 2020. I did 2021. For 2022, if you have $100,000 worth of income from your business and you are in a situation where you can set up a retirement plan, you do not have to make the contribution until September of 2023, September 15th of 2023, that you can deduct from your 2022 taxes. So there's a substantial amount of planning there. And there's a substantial amount of planning you can do with an individual that has a 401k plan. And with a 401k plan, sometimes there's a Roth deferral benefit offered by that 401k plan that you can put in up to $50,000 worth of assets into a regular part of the 401k plan and a Roth the part of the 401k plan. And what you can do is have your client donate and contribute to the Roth portion of the 401k plan, and the company then would match the same amount of the deduction into the regular 401k plan. It's a tremendous benefit that if you have a client that is in a 401k plan that has some extra money, because the Roth IRAs have a lot of benefits that the regular IRAs don't have. The problem with them is that you pay your tax now, and then you put after-tax dollars into a Roth IRA as opposed to getting a tax deduction for them. But the long-term benefits from a Roth IRA often outweigh the tax that you pay now. And they're in my handout on page 25, it's called a designated Roth referral, and where you can put into a separate account in a 401k, in the government 403b, 457 accounts. And there you can get substantial build up contributions into your Roth that way. Okay, now I'm going to turn to some income tax planning using trust. And one of the key trusts that you can utilize is the charitable trust, and Russ Rowe will be talking about those things. And we have, along with your handout, we have an actual charitable lead trust document and a charitable remainder trust document. And Russ will be able to give us some info about that. Very good.
Thanks, Fred. Again, I'm Russ Roll. I'm there. This is really weird to be talking to a computer screen. I've never done a CLE like this before. I kind of like to have feedback. So anybody in the audience here that's here today, if you want to ask questions, please feel free to do that. There's one person in the audience. Before I talk about charitable trusts, I want to make a couple comments about, number one, the captive issue that Fred talked about earlier, and also the offer and compromise issue. First, on the captives, I know we're here, it's December 8th right now, right? I think it'd be safe to say that it's too late for 2022 to contact any reputable captive managers to get one set up for the end of this year. It's just too late for this year. But it takes some time to get the insurance department's approval on things and so on and so forth. So something to keep in mind for next year, more so than this year. On the offers and compromise, again, this is my personal experience on offers and compromise, and I've been doing this for more years than I care to admit. I have found that the offers and compromise almost never work, and you're almost better off getting your client into currently uncollectible status and hoping or expecting or anticipating that the IRS is going to allow the lien that's filed against your client to expire before they become collectible. And then the liability goes away. Because with the offer and compromise, and Fred and I have had this on some joint clients, what the IRS is expecting you to do, the client to do, the taxpayer to do, is to liquidate all equity and assets and pay that as a lump sum up front, and then pay their disposable income, for lack of a better term, from the 433A form over 48 months. The problem with that is, number one, if you're in that situation, it's really hard to liquidate equity and assets because no banks are going to loan you money. And number two, if you do liquidate the assets and do it with debt, that changes your cash flow picture pretty tremendously. So it just doesn't generally work. So those are my two comments before I talk about charitable trusts. in the world of charitable trusts, there are really two different variations, and they're two sides of the same coin. There's a charitable lead trust and a charitable remainder trust. And the main difference between the two is who gets the income from the trust versus the remainder. With the charitable remainder trust, the grantor receives the income from that trust for a period of years, up to 20 years, or for a lifetime. And at his or her death, or the joint death of the grantors, the remainder in the trust goes to a charity. It's the flip side with the charitable lead trust. The grantor does not receive the income interest during his or her lifetime, but his or her beneficiaries receive the residuary or the remainder of the trust. The charity gets the income interest during the grantor's lifetime. So those are two different sides of the same coin, I always say. The charitable deduction benefit is basically, I'm going to talk primarily about the charitable remainder trust, is that when you put a lump sum of assets into the trust, you get an upfront charitable deduction for the present value of the remainder interest based on the IRC 7520 rates. And if you do it for the life of the grantors, it's based on their actuarial life expectancy, not their medical life expectancy. So the donor gets an upfront charitable deduction for the residuary that the charity is going to get at the end, and then receives the income for his or her lifetime. That income flows out of the trust, characterized as the way it was recognized by the trust. So it's either ordinary income or capital gains, depending on if you funded. Typically, a charitable trust is funded with appreciated securities, because the trust can then liquidate those securities without recognizing or paying the tax on the gain. One of the little tricks, I would call it, or techniques that a lot of people will use with a charitable remainder trust is they'll take a bucket of money, a bucket of assets, fund a charitable remainder trust that is going to generate a cash flow stream for the grantor for his or her lifetime or joint lifetime. And then remove the remainder from their taxable estate because it goes to a charity. And then what they will do is they will take that income stream from the charitable remainder trust and divert it, for lack of a better term, into an irrevocable life insurance trust that buys a life insurance policy to replace all of the assets that were given to the charitable remainder trust. So you basically, a lot of planners will call it giving away your assets twice. First the remainder interest in the charitable remainder trust, and also the irrevocable life insurance trust is obviously in estate tax free if it's done correctly. So that the life insurance replaces the assets that you're giving to a charity, and you disinherit Uncle Sam. Basically, that's it in a nutshell. The flip side of it, the charitable lead trust, there's also a deduction in the year that the grantor funds it based on the present value of the lead interest that you're giving to the charity, or the income interest that you're giving to the charity. Again, based on the 7520 rates and your life expectancy, the donor's life expectancy. The charitable lead trust can either be a grantor trust for income tax purposes or a non-grantor trust. If it's a grantor trust, then the income earned by the trust during the lead period while the grantor is still alive is actually taxable to the grantor. If it's a non-grantor trust, then the income earned by the trust during the lead period is taxable at the trust level, which Jeff can talk to that more so. The trust tax rates are a lot more compressed than individual tax rates, so it can be more expensive to have a non-grantor lead trust. I wish there was some way to ask for questions, because I would love to have questions if anybody has any.
Well, one of the questions I would ask, what kind of client are you looking for to do this? And I'm going to go to the charitable remainder trust. And why would you do that? Why would somebody want to do that?
Okay, first of all, you have to have first of all, it doesn't have to involve millions of dollars. It doesn't have to be millions of dollars at all, but it does have to be a client who has some charitable inclinations, I would call it, because at the end of the day, money is going to go to a charity, and if your client doesn't like money, his or her money going to a charity, then it won't work. But in terms of the leverage of doing it, there's really three different opportunities for, I'm going to use the word arbitrage. I think it's the right term. The first is, when you're computing the present value of the remainder, again, talking about the remainder trust. That's based on the IRS's actuarial life expectancy of the grantor, which doesn't take into account his or her health related life expectancy. So if you have a grantor whose life expectancy is significantly longer than his or her actuarial life expectancy, you can get a pretty well inflated charitable deduction up front. And also, if you couple it with the life insurance and you have a healthy grantor, they can get favorable life insurance underwriting to make the whole thing work even better. I'm not sure if that answers your question. Yeah, the other variable or the other arbitrage opportunity is the difference between the 75-20 rate and whatever the assets are going to earn once they're in the trust, which hopefully will be greater than the 75-20 rate.
Well, one thought, let's assume that you have somebody that needs some money and needs the cash flow, and if he has assets, his main asset is stocks where he has low basis and high gain. If he sells that stock right today, he'd have the capital gain, and it might be significant enough that he's in a higher capital gain rate, and it might be significant enough that he's got the 3.8% net investment tax, along with other things. So one of the reasons he may want to get into a charitable remainder trust, he puts it into a charitable remainder trust. There's no capital gain right now, but he'll get the capital gain over a 10-year period, and he can
Or life
have a
expectancy.
steady.
Yeah, and really what you're talking about with the charitable remainder trust is deferring the tax on the gain of an appreciated asset. And it's a great way to do it.
Yeah,
Great way to do it.
and part of this was year end, what are you going to do year end? And this is one of the things to think about, as to if somebody's got some, one of the problems with, you would have somebody that's in a mutual fund and you don't know what the capital gains sometimes are that are being sold there, and you're trying to manage that, and it's hard to do. But to try to come up and put something into a charitable remainder trust where you have a lifetime stream of income, and then going to remainder, especially if the guy's healthy enough to insure it, that he has an insurable risk, that's a tremendous benefit, because he hasn't lost anything and he's gained a reduction, and he's gained a steady capital gain.
And a deferral of the taxes. Yeah, I mean, unlike the captive comment that I made earlier, I would say that December 8th, it's not really too late to do a charitable remainder trust for the end of the year. Especially after you're given the documents by Fred. All you need now is a tax ID number and open a brokerage account for the trust and transfer assets.
Given the high standard deductions now, though, for married, it takes away bang for the buck.
It does. I mean, yeah, the question, I'm not sure if it was heard, is whether the increase in the standard deduction takes away the benefit of the charitable deduction. So that kind of leads into, this is not going to be something that somebody does with, say, $20,000 of stock or anything like that. It probably needs to be at least 100,000, I would imagine.
Yeah. It's a big capital gain that you're fighting against, and whether, I guess when you die, you get a step over the basis, but can be dangerous with the Pennsylvania inheritance tax. So it said you have to pay the tax on it, but
you're also limited to the 50% of the adjusted gross income also.
Actually, it's lower than that. I believe it's either 30%. If you're doing it with marketable securities, it's either 30 or 20%, depending on what kind of charity is at the end.
So, and that's, we're trying to, now, by contrast, the lead trust, why would you do a lead trust? To limit the inheritance estate tax to somebody that's pretty wealthy?
Yeah, because that's really the only advantage to it, because you can really design it as almost a zeroed out lead trust, so that the actuarial value of the remainder that goes to your kids or your beneficiaries is valued at zero for gift tax purposes.
Yeah, because of the charity gets the lead, and and then whatever, hopefully it grows more than the IRS 20 rate, and so that there would be assets left over, and substantial assets if it works out right.
That would pass estate tax for. There's a Steve Lineberg has a software program out there called Number Cruncher. I'm not sure how many of the people on this call are familiar with it, but it's a great little software program to do little what if scenarios with charitable remainder trusts and charitable lead trusts. You can really play around with the numbers to figure out what works best.
When you're doing a charitable lead or remainder trust, who can be the trustee of that?
The grantor.
So in other
Can.
words, Harry Moneybags, your client, has a capital gain he wants to get, so he puts the assets into a charitable remainder trust.
Mhm.
He's the trustee. And then he can, or one of his family, it's not, it doesn't have to be managed by somebody else.
No,
It's self-managed.
The most common one I see is where it's formed by a husband and wife as co-grantors. And they're co-trustees. It's designed to pay an annuity over their joint life expectancy. And the survivor of the two is the remaining trustee of the trust. So it's controlled by the husband and wife unit.
Yeah, and if you had somebody that was just sued for malpractice for some reason, would you put it there and such that it would be a stream of income that would be in the trust, not subject to spendthrift or anything?
Fred set me up for an impossible question to answer. I don't know whether that would violate the fraudulent conveyance rules.
Assuming that you could get away from that.
I guess it would work.
What about putting money into somebody in the same situation? And he's got 2 employees and he wants to keep the employees that are they're both 20 years old and he's 60. And you put money into the defined benefit plan. When you're 60, it would be, you put a $300,000 in the defined benefit plan. Or obviously you have to take care of the employees and therefore you take that $300,000 out of his business and you have a steady anti-alienated remainder benefit for him. Did you ever try that?
I'm not sure I'm following your question.
In other words, would you be able to protect the dentist from, so that you have long-term income where he might lose it in a malpractice case?
So you're taking out of this question has nothing to do with a charitable trust.
Correct.
It just has to do with really funding a defined
Yeah,
benefit plan to
the stream
protect
of
assets.
income. It's a stream
I
of
think-
income question.
I think that actually works. Yeah.
Yeah.
It's too bad Brad is, he would probably answer that a lot more.
Yeah, so that's, well, we'll send that over to him. So,
All right.
I'm gonna, is there anything else in terms of transferring money into, trying to transfer money to your children through, transfers into S trust, S corp trust, or any of that sort of thing?
The one other thing I would think about as a possible year-end planning, although it's probably too late to do this one, is for the family to establish a private foundation and fund it with an appreciated security. And then allow the children or the next generation to be the managers of the foundation and collect a compensation for it.
How would you set up a foundation like that? Well,
I would generally do it as either a trust or an LLC. It requires an IRS approval on its tax exempt status, so.
Yeah.
So that's why it's too late.
Well, let's
to do
assume
it.
that you had it into September, or you had enough time to do it. How would you set up, so I've had some foundation questions. Describe how you would set up a foundation, the circumstances and what, why, and how
Well,
would you explain it to us as if we were third graders?
The actual formation of it, again, using a trust, because that's generally what I do, is the IRS has required mandatory language that has to be in the trust in order for it to qualify as a foundation tax exempt. Pretty easy to comply with that. And then the bigger hurdle is applying for tax exempt status before you fund it, which is, I think it's a form 1024.
Yeah, okay.
1024 is opposed to 1020. Well, 1023 is for public charity, but
Yeah. I think there's a provision in there for private foundation in the 1023 also.
I don't know. I thought it was 1024, but
Either
then
way, it doesn't matter.
then ongoing, there's going to be a 990 PF filing requirement every year.
So if you were to explain to our investor in the audience, that here's why you want to set up a private foundation and here's how it can be done approval. And for you to set it up, more towards year end, you would be able to put in $100,000 in. What would your charitable deduction be for your placement in the private? My understanding is if you put in the private foundation this year, and if just as long as you keep it for exempt purposes for the future, you can get the deduction now. Is that correct?
All in the first year. I think that would be a 30 or 20% AGI limitation.
Probably 30%.
Well, if it's marketable securities, maybe 20%, I think. But the deduction would be in full, subject to the AGI limitations.
So, and does it have to be done before December 31st?
Yes.
Can you make a later, you can't accrue?
No, and technically you need to have the IRS approval on its tax exempt status before you fund it.
So to do the foundation, you would want to start early in the year so that you get the approval, and then your 10, 23, 20, 24, which now has to be done online. I don't know if you do that yet.
I did not know.
Yeah, so that should change. But I haven't done a foundation for a while, and that's why I'm pointing out the questions. I'm glad you brought it up.
Well, the 990 PF can only be filed electronically now too.
Yeah, all of it.
Yeah.
All of them. See, that's,
Oh, that brings up another point on the charitable remainder and lead trust. Well, remainder trust has an annual filing requirement of a form 5227, which is an interesting tax return. I'm not sure, Jeff, if you've ever done one before.
No, I haven't.
It's an interesting tax return, and it cannot be filed electronically yet, which is
it's all bizarre. It's
pardon my language, but it's a real pain in the ass because it goes somewhere in Utah.
Mhm.
And then my clients will start getting notices from the IRS saying you didn't file your return. It's $20 a day late filing penalty. Even though we mailed it certified and have the green card back, but it landed on a desk in Utah somewhere.
Speaking of late filings.
Okay.
One of the issues with the shareholder basis and your S corporation filings that have to be done March 15th or September 15th upon extension. And if you're late on them, and I don't know if you've had problems with calculating the shareholder basis or people getting the information to you, because nobody knows what a distribution is, and anything that's not deductible or arguably the distribution goes. It's and the problem with late filing information returns is significant.
You're talking about the 1120S?
Yeah.
Yeah, what I've always done, if I don't have the information, what's that form 72?
Yeah, the extension.
No, the basis.
Oh, yeah.
That you have to attach as a PDF.
Yeah. Yeah.
If I don't have the information to do that and e-file it by September 15th, I file it with zeros on it. And then I'll go back and amend it later, just to avoid the late filing.
Yeah, and I think all of us have filed things that are not complete, I guess would be an answer with the concept of having to amend it, because that's such a massive potential problem. So I'm going to finish up here with the Secure Act. And this came into play with me for I had a client that her and her husband were married, and both of them had pretty substantial 401k plans. The husband ended up having 401k plans. I'm going to say his was $1.2 million. And then after he retired, he and his wife decided to get a divorce. So they got divorced, and when they divorced, the wife got, say, $300,000 of the split of the retirement assets, because she had her own retirement. So, but anyhow, he ended up with about $900,000 worth of a 401k plan in 3 different plans that he rolled over into 3 different IRAs. So what happened then was he got divorced in January, and then his wife fell and got hurt in April. She had a situation where she fell, hit her head a little bit and was partially paralyzed. And so then he was helping her for 2 more months, and then he died. So he died with $900,000 worth of retirement or IRAs. And the problem became the wife's name was the ex-wife's name was the beneficiary on the 401k plans. And the next question is, who was the beneficiary? Because he had a wife and a daughter. And the answer is, under Pennsylvania law for wills, if somebody gets divorced, the spouse is considered to predecease the husband. So therefore, whatever was supposed to go to her in the will would go to whoever the secondary beneficiaries in the will were. For the IRAs, it is the same thing.
Really?
Yes. I will pass the law along to you, but what the law says is that it doesn't change the beneficiary unless it's, I want to say, elected or that's desirable. So what we had was a spouse, and he was over the age where he had to get the required minimum distributions, I think. In any event, she was less than 10 years younger than he, which is one of the exceptions under the Secure Act, so that if she would get the, I'm going to call it the IRA, if she's a beneficiary of the IRA, she could take the IRA out of her expected lifetime and not the 10 years. By contrast, the daughter, who's 40, would have to take the IRA over a 10-year time period. Now, the question is, if you're in the position of having the daughter who is now the beneficiary, once you send the Pennsylvania law statute to the lawyers at the IRA fund, and they accept it and they name the daughter as the beneficiary after they see the Pennsylvania law, which I might add I sent to them, and or leave it with the mother of the ex-spouse of the beneficiary. So, and the ex-spouse now is in a rehab center for several years, and she would get a medical deduction for the money she'd get from the IRA. So, and it's, $5,000 a month or whatever, because she needed skilled nursing care. So that played into it. But even absent that, just on the finances of taking, the wife would have to get the IRA at 15% inheritance tax. And then she would have to pick up the income tax for her lifetime. And we assumed a 6% growth rate in the assets after the 15% was reduced. And then the growth rate from there, as compared to the daughter who inherits the IRAs at 4.5%, but her tax rate, she actually has a pretty decent job, was a little bit higher. And so what we did on the finances, if we did the pure finances on all of it, if we left it all in the wife's name, the overall long-term benefit would have been greater for her than it would have been for her daughter. But the 15% was such a hit, and the whether or not the IRA was going to internally grow at the 5 or 6% rate. So we split. We gave there were two of them that were 400,000, and one was 100,000. So we gave $500,000 to the wife, let her remain the beneficiary at 15%, which she wasn't happy to pay, I can tell you. And we left the other one with the daughter, and which gets to the significance of trying to plan with your IRAs, because they are subject to such a significant inheritance tax hit as well as an income tax hit, and also trying to utilize, and if you want to plan, you plan such that if somebody's going to be in a nursing home or have some ability to use the medical deduction, which is still pretty tough. It's a high bar to get to. But if you use the money out of the IRA to first, instead of the money out of the non-qualified funds to pay for the medical expenses. So that's another type of planning that I've done occasionally. Do you have any comments or thoughts about that?
But then you have to pay inheritance tax on the money that the mother gives to the daughter after she passes away.
That we didn't, the answer to that is correct. The answer to that is correct. And, it would at least be a 4.5% rate, but the trying to figure out which would be the most, where it is. And so we actually put that in there at the end, or I put it in, and that's why we split the difference as to where we go. But her tax rate, because her husband's pretty wealthy and have a higher tax bill to begin with, and that's why we did it. But that point's taken. But it's complicated dealing with the IRAs, and it's also complicated. Right now, I have a situation where the first primary beneficiary in the IRA is going to be the wife, and then this mixed family where she has 2 kids from a prior marriage, he has 2 kids from a prior marriage. So he's trying to keep his money, give it to his wife, and then benefit the children later. So he's trying to place the IRA into a trust with those same terms. Have you ever done anything like that with the IRA trust? Us?
Long time.
And you have to watch, because it could you could shorten the required minimum distribution period if you have the wrong beneficiary.
Right, with the Secure Act, doesn't that become relevant?
If
No
it,
matter what.
well, unless the wife is within 10 years of age. So whether or not you can, that's a planning process of who to give it to and when to give it to. But if you give it all to the wife, then she can keep it. It becomes hers. And if in fact he's less than the 70, 70 and a half, I guess, it can be hers completely. And then she could give it to, but she won't give it to his kids. It's a problem. And and so you're paying the penalty for protecting assets for your own children. And trying to do it. United States savings bonds and charities. Have you ever dealt with those? And it's my understanding that, because I haven't done this, I haven't done it ever, to tell you the truth. If you have, I've just looked into it because I got a new client that has a substantial amount, and I think they are H bonds from 100 years ago, wherein they quit paying interest on it, but they are almost 100% taxable, because it's they bought it for $25 and now they're worth $5,000 each or whatever. But there's no way that you can transfer them before you die and pass in other words, you cannot put U.S. savings bonds into a charitable lead trust or a charitable remainder trust, because you have to pay the tax on it before you do it. But it's my understanding that if in fact you name the beneficiary of those bonds in a will, that the bonds can go directly to the charity, and the charity, not the estate, has to pick up the income on them. Can pick up the income on them. You can make that direct transfer, and it's 100% deductible as a charitable deduction at the estate. I don't know if you've ever done that.
It's not IRDs.
Well, it is, but you can't. You can get rid of it that way. It's my understanding. So that's a. Since we're talking about planning, you always come up with a planning question that you don't know the answer from, and you embarrass yourself in front of a whole crowd of people here by not completely knowing the answer to that. But that's sort of, what we do. I have a concept on the Secure Act, and for those of you who don't know, IRAs now, unless they go to a spouse, the IRAs lost they used to call it a stretch, because now, in general, the maximum time period you can pay out an IRA is 10 years, unless it's given to a spouse. And there's 3 other exceptions. One of which is if you have a minor child of the original owner can get it, and you can have, it doesn't have to be paid out over 10 years. If your spouse or beneficiary is younger than 10 years than the original owner, they are an eligible, what is known as an eligible designated beneficiary that isn't subject to the 10-year limitation. And the third one is someone that's disabled or chronically ill. And you can plan to give your IRAs to them and you aren't subject to the same 10-year payout. But other than that, you would have a 10-year payout. And, if you hold them until, obviously, to your past, you still have the inheritance tax issue over there that is significant. So that is something else that you would have to deal with. I have a couple other comments here about retirement planning, one of which I sort of talked about a little bit, where I'll get somebody that's a single contractor, or they're anesthesiologist that gets paid with a 1099, and they have a Schedule C, and they are subject to the self-employment tax. And one of the things we've been trying to do with them is get them into a one-person defined benefit plan, and assuming that they're getting $500,000-$600,000 a year, and maybe if they're a little bit older, you can put them into a defined benefit plan and get a pretty significant tax deduction as long as you pay that into their plan. And most anesthesiologists are almost forced into retiring when they're 65 because they physically, mentally may not have the skills to monitor safely someone that's they're observing that's under anesthesia. Some of the anesthesia nurses and or doctors that are putting in work at pain clinics, and they are injecting pain medication directly into nerves, they can only work so long also. But in any event, they are good candidates for a defined benefit plan that you can put, up to $250,000 almost as a deduction, and plan for and spread their income out over longer years. And sort of one last thing here I'm going to talk about is some inheritance tax things that people aren't aware of. Off with the IRA, I was just talking a little bit about how you can try to manage your IRAs with various deductions and trying to get the best bang for the buck out of your inheritance tax return. Other things being equal is fairly simple. 2 things that come to mind are if in fact your family owns a farm or your family owns a family business, they can be transferred with 0 inheritance tax if the business or farm stays within the family. And I just had one of those not too long ago where there were 3 children. They took over, since it was something like similar to a daycare business operation, and 2 of the 3 wanted to continue in the business. So the business was worth about $900,000. So 2 of the children did not pay, that took over the business. There was no inheritance tax on that portion of the 3. So $600,000 went inheritance tax free. But the other child that did not get the business, and the other 2 more or less bought out, had to pay inheritance tax on his $300,000. So it's a pretty nice deduction and pretty good for anybody that's trying to do that sort of thing. So, and I'm going to take one last look at if there's anything I missed. I wanted to speak to. Russ, do you have any comments about any other types of planning that you with your year end? One of the items that I do with some of my clients, one in particular, they, in fact, there's a couple nonprofit clients I deal with, and there's a person that does sell some securities that all require audits. So at the end of the year, I try to get them quote unquote audit ready so that when the audit comes around, all the information is available and readily available for the year-end tax planning. What people often don't know with nonprofit tax exempt organizations, there's federal filing that has to be done, but there also is a Pennsylvania charitable filing, BCI 10, that is a substantial amount of paperwork where you have to provide a lot of the information about the nonprofit tax exempt organization, and you have to do a financial accounting that's similar to a compilation review, depending on which is an accounting term, a review, which is a more sophisticated financial statement, or an audited financial statement, which I believe now it's if you have more than $750,000 worth of receipts, you have to do an audit for a nonprofit entity. So all of those things towards the year end, if in fact you're doing your accounting, that is something that you certainly can take advantage of. And finally, in terms of planning, with everyone seemingly using credit cards, ACH payments, other things, trying to make sure that all the information your client has readily available, which more often than not doesn't happen. The other people on our panel totally agree with that. But that's some of the planning that I do for year end. And with that, I think we're about done. So anybody have any other questions or comments? Hearing none. So I think we're about ready to go then. So thank you very much. And I think this is it.